Hello and welcome to one and all. So we'll continue with the topic agriculture to the next important problem faced by the farmers. So that is in the area of finance, agricultural credit and rural indebtedness. So first out of that, we'll check out the topic agricultural credit. Okay. So basically the financial requirements of the farmers. So you can categorize based on purpose as well as based on time. So the financial requirements of the farmers, it can be categorized into two based on purpose as well as based on time period. So based on purpose, it can be either for productive purpose in the sense if the farmers are borrowing loans for cultivation, anything related to cultivation. So that is productive purpose for cultivation, and it could also be for unproductive purpose. So unproductive purpose, it's for personal reasons. So for personal reasons like celebrating the festival, celebrating the marriages. So like that, for any personal reasons also they can borrow. So that is not for productive purpose, that is for unproductive purpose. So based on time, it can be the loans can be borrowed. So mostly here we are checking out what are all the productive purpose. Okay. So it can be first one, it can be short-term credit. So short-term credit is for a period of less than 15 months. So less than 15 months. This could be for, for the purchase of seeds, fertilizers, or any of like that, the agricultural fertilizers, pesticides. So these loans can be taken for short period of time, that is less than 15 months. That within that 15 months, the farmer they have to repay the loan along with the interest. So the purpose is for purchase of seeds, fertilizers, pesticides, etc. And or it can range for medium term loan. So medium term loan or credit, it ranging from a period of 15 months to 5 years. So this could be for any reason like for making some kind of improvements on land. So that is for making some improvements on land, or if they want to buy cattle, or uh, some agricultural tools, implements which are not very costly, tools, implements useful for cultivation. So these kind of loan can be borrowed for a medium term period ranging between 15 months to 5 years. And finally, the next they can borrow the long term credit. So the long term credit is for a period ranging with more than 5 years. The term period is more than 5 years. So this could be for, if the farmer they want to buy additional land. So if they want to buy additional land, or if they want to like for example providing or developing irrigation facilities, or if they want to have some permanent improvements on land, or if they want to buy some costly agricultural machineries, etc. So they can, which is going to be slightly expensive. So all this could be borrowed for a period for more than 5 years. Then they are categorized as long term credit. Okay. So all these are for productive purpose. So that is the for anything associated for cultivation, any loan that is borrowed by the farmers either for short term, medium term, or long term, which is associated with cultivation, they come under the category of productive loans. And other thing, if it is not for cultivation, if it is there for personal reason, they could come under the category of unproductive loans. Okay. So now, either it is productive or unproductive, there are different sources of agricultural credit from where they can borrow the loans, either for the productive purpose or for the unproductive purpose. So there are two sources of agricultural credit to the farmers. So one is the non-institutional sources of credit, and another one is the institutional sources of credit. So non-institutional sources of credit, one is they are mostly the traditional. They are the traditional sources of credit that farmers for a long period of time they have been borrowing loans through this non-institutional sources of credit. So they are the traditional sources of credit, and they are also called as informal sources of credit. Informal source of credit, and most often they carry a high rate of interest. So these are some of the features of non-institutional sources of credit. Okay. Now coming to the institutional sources of credit. These are all the sources mostly established by the government, established or authorized by the government, and they come under the category of formal sources of credit. Formal sources of credit, and the main difference here is that the aim is to provide credit at less rate of interest to the farmers. So these are all the some of the features of institutional sources of credit. So now let us check out what are all the various non-institutional sources and what are all the various institutional sources of credit to the farmers. Okay. So first, the non-institutional sources of credit. So who are all the people who come under the category of, who are all the lenders who come under the category of non-institutional sources of credit? The first thing, non-institutional sources of credit comprises of, first and foremost, money lenders. So money lenders. The second in the order of importance, landlords. And sometimes the farmers can borrow from the traders and commission agents. So these traders and commission agents are the intermediaries who help the farmers in selling their produce. Okay. So from them itself, the farmers can borrow loan, but they will put a condition that the farmer have to sell the commodity to the same traders and commission agents while they are selling the commodity. And after the harvest, after when the produce have to be sold, they will make a condition that if they are selling the commodity to them only, they will lend the loans to the farmers. And money lenders are the one who are, there are two types of money lenders. One is the professional money lenders and another one is the agricultural money lenders. Professional money lenders, their main job is money lending. Agricultural money lenders, they are like a landlords. So they are the landlords, they are the cultivators. At the same time, side business, they also have the money lending business. That is the agricultural money lenders. And sometimes the farmers can borrow from their own landlords. Most of them, the small and marginal farmers, they are taking the land on leads from the landlord, isn't it? They are working there they are cultivating the land, taking on the land on lease. They are working there as a tenant, isn't it? So sometimes the small and marginal farmers, they can borrow loans from the landlords themselves, their own landlords. And the third category is the traders and commission agents. And the fourth, the least important source of non-institutional credit is relatives and friends. So this is the, this is very undependable. So the least source of importance, and most of the time there will not be any rate of interest also. But anyway, they come under the category of informal sources of credit. So the most important of all this is the money lenders. Okay. And what are the advantages? Why the farmers are approaching the money lenders or the non-institutional sources of credit? Because they have the some advantages or the features of non-institutional sources of credit is, the main advantage is they supply credit. These mainly this money lenders and landlords or whoever, they supply credit to the farmers both for productive and unproductive purpose. So it is not that farmers they need money, they need credit both for productive purpose as well as for the unproductive purpose. So most of the institutional sources like banks and all, they won't lend loans for the unproductive purpose. Mostly they will lend, maybe even if they are lending also, they will lend loan mainly for the productive purpose. That is, productive purpose means whatever the loans associated with cultivation. So most of the institutional sources, they will lend loan only for that purpose. But most of the time, our farmers, they need loan for the unproductive purpose also. So for which they have to depend only on the non-institutional sources of credit, especially the money lenders. And another reason, another advantage or another feature is they are easily accessible. They are easily approachable or accessible to the farmers because they are the someone who are living among them in the rural area itself. And also there are no not much of a formalities to be, I mean, whatever the formalities that are required to be fulfilled in the non-institutional sources of credit, those kind of formalities are not there in the non-institutional sources of credit. So they are always available, easily accessible to the farmers at any time. So because of these advantages, most of the time the farmers, they approach the non-institutional sources of credit. But then the non-institutional sources of credit, they have several defects. So the defects of non-institutional sources of credit. So first and foremost is, it is a high rate of interest. The non-institutional source of credit, those credit, they carry a high rate of interest because they don't come under the formal sources of credit. So most of the time, I mean, it was actually, if you talk about from the time of independence and all, the rate of interest were ranging from 18% to 50%. So there is no uniformity. So no uniformity in the rate of interest. So that's why it ranges from 18% to 50%. So it differs from one area to another area, from one money lender to another money lender. Okay, so there is no uniformity, and on the top of it, the exorbitant rate of interest was charged by the all those non-institutional sources of credit. And then the main purpose of lending loan. Why these non-institutional sources, they are lending loan for unproductive purpose? Because for the ultimate motive, ulterior motive of taking the land from the small and marginal farmers. So because they know that if the farmers are taking loan at high rate of interest, they will not be able to repay the loan. So most of the time, the farmers, they take the loan by mortgaging their land. So they know that these farmers will not be able to repay the land and on the repay the loan. And on the top of it, they are borrowing for, most of the time, they are borrowing for unproductive purpose. So finally, they could cheat the farmers. Anyway, the farmers are ignorant. They can cheat the farmers and grab the land from the small and marginal farmers. That is the purpose. These non-institutional sources of credit, they're lending loan for the unproductive purposes also. Okay, so the small and marginal farmers are cheated, that is if they are unable to pay, and their lands are grabbed by these non-institutional sources of credit. And on the top of it, the landless agriculture, they don't have any land, isn't it? So the landless agricultural laborers are forced to work as bonded slaves. So throughout their lifetime, anyway, they are supposed to work till the debt is repaid, but throughout their lifetime, they will not be able to pay. So throughout their lifetime, they will be working under the lender as a bonded slaves. Okay, so these were some of the main defects of non-institutional sources of credit. But anyway, since this non-institutional source of credit, as I mentioned, they are easily approachable, easily accessible to the farmers. So once upon a time in 1951-52, so the share of non-institutional sources of credit out of the total agricultural credit, the share of non-institutional sources of credit was as high as 93%. So 93% of the total agricultural credit highlighted. So 93% of the total agricultural credit was from the non-institutional sources. This was in 1951-52. So institutional sources. So only, so the remaining only 28%, sorry, remaining only 7% was from the institutional sources of credit. So this was the dominance of money lenders and the other non-institutional sources of credit at the time of independence in the country. So anyway, the same zamindars, the same landowner, they themselves are the money. We have seen what are all the problems of the zamindari system, isn't it? So the same zamindars, they themselves lend the loans to the farmers with the ulterior motive of taking the land, grabbing the land from the small and marginal farmers. So this was the situation at the time of independence. So after, along with the land reforms, technological reforms and everything, along with that, another measure undertaken by the government is to establish the institutional sources of credit. Okay, so that the farmers, they need not have to depend upon the money lenders. So after other, along with all those things, after independence, the government started several institutional sources of credit. So the main objectives of these institutional sources of credit was, first one, so to provide, because the farmers were cheated by the money lenders by charging high rate of interest, isn't it? So to provide adequate and timely credit without any delay, required amount of credit to the farmers, and most important thing, at cheap or at less rate of interest. That's the first objective. And through this, the government want to uh, remove the hold of money lenders in the rural areas. To remove the money lenders from the rural areas, or even if the money lenders are there, they have to be regularized. I mean, they have to be given the license. So only those money lenders who get the license, they will be allowed to lend loans. So once they are licensed, when they get the license, then they cannot charge more interest rates apart from what that is prescribed by the government. So otherwise, they will, I mean, they cannot practice that money lending business. So to remove the money lenders from the rural areas or scenario, and to provide or make available credit facilities to all regions of the country, of the country. Okay, so if you want, you can to remove the money lenders. So these were all the main objectives or aims when the government established the institutional sources of credit. So some of the institutional sources of credit uh, comprise of, so institutional sources of credit, broadly they comprise of first one, cooperatives. Second, commercial banks. And third one is the regional rural banks. This is RRBs. See, normally we have financial institutions catering separately specialized financial institutions for lending loans for agricultural purposes, and there are specialized financial institutions catering lending loans for the other apart from agriculture, mainly for the industrial purposes. So these are all the financial institutions, that is cooperatives and commercial banks, both for agriculture and non-agricultural operations also, even for industries also. And these cooperatives and regional rural banks, they all mainly specialize in lending loans for agricultural purpose. So like that, for example, we are having specialized financial institutions for the industrial purpose also. IDBI, even ICICI was once started for lending loans for the industrial sector only. So IFCI, like that, we have several financial institutions that cater to the needs, financial needs of only for the industrial purposes. Like that, we have these kind of financial institutions, they cater to the needs of agricultural purpose. So like that, and commercial banks, both for agriculture as well as for industrial and trade purpose also. So these are all the main financial institutions that are providing loans for the agricultural purpose. Okay. So now let us check one by one what are their operations and what are their structure. So the first one, cooperatives. So cooperatives, so actually it was the cooperative societies, it was established as early as in 1904. So 1904, through there was a cooperative credit movement started in the country in 1904 through cooperative credit societies. So these cooperative credit societies, they provide both, I mean, they provide short-term, medium-term, as well as the long-term loans to the farmers. So actually the short-term and medium-term loan of the cooperative credit society, it has got a three-tier structure. That is mainly this short and medium-term loans. Loans at three-tier structure. So at the bottom level, we have this is the lower level. Lower tier, we have the PACS, that is a Primary Agricultural Credit Society. And then in the middle level, so this is the middle tier, we have the district cooperatives credit banks. And then on the top level, we have, this is the apex, the top or the apex level. So the apex level, we have the state cooperative banks. Okay. So this is the short and medium term loans. So this is the structure of the cooperative credit societies. So this, first let us start with the PACS, which is operating at the bottom. So PACS, the full form is Primary Agricultural Credit Societies. So that is the PACS. And this one, they are organized at the village level. So they are organized at the village or the grassroots level. So these this PACS is having the direct contact with the farmers. Okay, so they are the one who lend loans directly to the farmers. So they provide, the PACS, they provide short-term and medium-term loans to farmers, directly to farmers. So this is the bottom level, that is the PACS. Okay. Next, the next one is the, we have the so the second one, what we are having is the DCCBs. That is, the full form is District Cooperative Credit Banks. So this is organized. So DCCBs, they are organized at the name itself says they are organized at the district level. Okay. And then on the top, we are having the SCBs, that is, the full form is State Cooperative Banks. So state cooperative banks, they are at the top, the apex level. So organized at apex or at apex or at state level. And the state cooperative banks, it coordinates the activities of the district cooperative banks and the primary agricultural credit societies. So this state cooperative banks coordinates the activities in the sense that the extension of loans by the district cooperative banks and the primary agricultural credit societies. Coordinate the activities of DCCBs and PACS. Okay. So this is the short term and medium term loans is divided as a three-tier structure. Okay. Apart, actually, the state cooperative banks provides a financial assistance to DCCBs. The DCCBs provides a financial assistance to the PACS, and NABARD provides the assistance to the state cooperative banks. Okay, so these three, this is for the short term and medium term loans to the farmers. And then apart from that, apart from short and long medium term loans, we have seen, isn't it, the farmers also need the long term credit for the purchase of additional land, costly agricultural machinery, etc., isn't it? So the long term loans So they are provided by two banks. One, that is PCA RDBS. That is, the full form is Primary Cooperative Agriculture and Rural Development Banks. So these rural development banks, earlier they were known as the land development banks. Even before, they were known as the land mortgage bank. So this now it is called as the rural development banks. So these rural development banks, normally they engage themselves in lending long-term loans to the farmers. So this is associated with the primary cooperative society. So they are primary cooperative agriculture and rural development banks. And another one, SCARDBS. That is, the full form is State Cooperative Agriculture and Rural Development Banks. Okay, so these two banks specialize in the long-term loans, long-term needs of the farmers. Okay, so still two more sources are there, that is the commercial banks and regional rural banks, which I will explain to you in my next class. Okay, so hope the concept is clear to all of you. So if you find this video useful, please like, share and subscribe. And if you have any doubts, please mention in the comment box. Okay, so until my next class, take care. Bye bye.